Hi everyone, so today I will explain to you what is the accounting treatment for deferred income. Deferred income is just income that you have received in advance. Question approach, you need to identify the keywords in the question, and this is usually in advance. And to note is that for expenses, it is the contrary. When we say in advance, it is an asset because it goes to prepayments and therefore a debit balance. However, if we say in advance for deferred income, it would be a liability and therefore a credit balance. So be careful with the wording and make sure you know if you're dealing with expenses or income. You need to know what is a year end, check all the dates mentioned in the question, and you can draw a timeline or a T account. XYZ Limited sublets parts of its restaurant to tutors and rent is received quarterly in advance. You have the opening balance prepaid 5,000. You've got several receipts made during the year, and the question is asking you calculate the accrued or deferred income and the profit and loss income at year end, and the year end is the 30th November 2017. Keywords in that is in advance, and you're dealing with income because it is related to rent received. Year end is the 30th November 2017, and you have taken note of the receipts made during the year. It is good for every single question for accruals, prepayments, accrued income, and deferred income, but you list what you already know. Year end is 30th November 17, therefore the start date is the 1st of December 16. Start date is always one day after the year end, in this case the 1st December, and then you go back 1 year and it will be in 2016. You have different payment dates here, and you have the quarters related to each of them. Quarters are 3 months, so be careful with that. If it is quarter ended 31st December 16, then it relates to October, November, and December. Similarly, if it is quarter ended to 31st March 17, then it relates to January, February, and March. This is the same for the other quarters, and what we need to calculate is the P&L income. P&L income consists of always 12 months because you're reporting for the 12 months year end 30th November 17, and the start date is the 1st of December 16. Therefore, you work in a chronological order. From the 1st of December, what you have as information is it was 15,000 for the quarter. You only need December, therefore 15,000 divided by 3. We don't care about October, November 16 because it doesn't fall in our accounting year. This quarter is fully relevant to our year, this as well, and this as well. So you just list the full figures in here. For the last quarter, our year end is November, therefore December does not relate to our year, and therefore Anything which was received for that month needs to be deferred. In this case, in a P&L income, we only need to account what relates to our year, which is October and November 17. Hence, 2/3 of 21,000 and you get your 14,000. A P&L income is then 70,000. Always do a quick check when you do your P&L income or P&L charge that you have accounted for the whole 12 months of your accounting period. Deferred income will then be December 17, which is just for 1 month, so 21,000 divided by 3 is 7,000. The double entry would be credit deferred income liability, and you would debit the income account. You can use the accounts to illustrate the answer. You have on the top rental income and at the bottom deferred income. What you need to do is to first insert the brought down given to you 5,000, and this is in the question 5,000. Deferred income is a liability, so any opening balances needs to be a credit balance. The question is, what if the opening balance of 5,000 was not given to you? What you need to do is you need to think of a year behind, year end November 16. The carried forward figure during that year end will be the brought forward figure that we have this year. If you remember, in October 16, XYZ received for the quarter October, November, December 16, $15,000. Hence, for that year, deferred income was for December because they have received 1 month extra, which doesn't relate to November 16, it is after that. Therefore, deferred income during that year was 15,000 divided by 3, and hence explains the brought forward balance. The next step is to reverse the brought forward. So double entry is debit deferred income and credit your rental income, because now you can recognize that income during your year 17. Cash receipts now. Double entry is debit cash in, credit rental income, because P&L income has credit balances. The first receipt of 15,000 was not included. As you can see, it's just these four. Because if you remember, this was received in October 16, which is well before our start date. Our start date, remember, was the 1st of December 16. The next step is to post the year-end deferred income, which is debit rental income and credit the deferred income. We are debiting the rental income because we need to unrecognize this cash element for part of this payment, because some of it relate to next year. The P&L balance would then be the rental income figure in your profit and loss, and it will be shown as a credit in your P&L. This is the same like the figure you have here. Deferred income, same principle. You balance off the accounts, you have a carried forward figure of 7,000, which is the same like the one you have calculated here. Whether to use a T account or not is a judgment call, but I would recommend using a T account only if the opening balance is given to you. Otherwise, you will have to go through all these workings. What I would like to point out as well is that for the exams, if you want to be quicker, A small trick is, deferred income always has a brought down balance on the credit side. Therefore, instead of putting the deferred income T account in your calculations, you just always have to put the brought down figure on the right. As for the year-end rental income deferred, you put it on the left side because the carried down figure is always the opposite, where the brought forward figure would then be on the right here. So carried forward 7,000 and the will be a brought forward of 7,000 here. Just like the deferred income account, brought down is on the right and carried down is on the left. Then you don't need a deferred income account, you just directly put brought down 5,000, carried down 7,000. But it is up to you which one you prefer. But the correct way of doing the accounts is by the first method, which is a longer one. You can use a timeline as well to show how you've got your deferred income. If we look at the last receipt, October, November, December 17, you received 21,000. That's the timeline. October, November, December, 21,000 received for this quarter. However, the year end is November 17, hence the cutoff. And anything which is after that, then this income doesn't relate to our year and we need to defer it. Hence 1/3 times 21,000, which equals to the deferred income figure you've got here.